Good morning, hello to everyone, and welcome to this Natixis Research Outlook 2024. We are very happy to have you here. Today we are going to discuss what are our main forecasts, our main ideas for the incoming year. We call it pivoting to a new normal. We think it's going to be keep normalizing the economies, and we will discuss the impact on the market. So as usual, I will say two sequences for today. First thing first, a macroeconomic one to this soft landing scenario of ours, which is more a bit. It's close to a Goldilocks scenario, to be honest. I will be back on that. And second sequence will be more on market as usual. We are going to publish on the next following days the document, a nice publication with all this. So you will have all the slides, all data and forecast for next year. As usual, again, do not hesitate to ask some question. I will try to ask some question to our experts. We have almost all the team here in Paris for this live event. So I will ask some question to our experts, but best questions are coming from you, so do not hesitate to use the Q&A. I will be transferring your question. So just as a few words of introduction for our scenario. Last year, at the same period of time, we were probably, well, sorry for this backward-looking story, but last year we were probably maybe the only one institution not forecasting a recession for Europe, and we were right into this. But remember that at the same time last year, we were forecasting a huge recession, especially in Germany with the energy crisis, central bank hiking rates like mad, and so on and so forth. Well, at the end of the day, I think we were right. Eurozone will be escaping a recession this year. We were not forecasting a recession either for the US, despite the inverted yield curve, all the buzz around that. It was not there, but clearly we were not expecting such resilience of the US economy, and north of 2% of GDP growth. It's now even above its pre-COVID trend, the US economy, so quite impressive performance, and we are going to discuss that with our expert. Now, what about 2024 in our scenario? First thing first, like I said, it's not a Goldilocks scenario, but clearly we keep having this view, and it was the case in 2023, that the peak of the energy crisis is behind us, and that inflation will continue to go down. If you take the energy component, we will discuss that with our experts, with Joel especially, but energy, we don't see a big story. First thing first, we have this global warming, 1 degree more, and you have 7% electricity consumption less. So the stocks of gas are full like never before in Europe. So we consume less electricity. We have more electricity out of gas. Nuclear plants at last are back in France into functioning quite reasonably well. Germany has accelerated like very, very impressively its transition to more renewable energy. Year to date, in November, up to November, the electricity produced in Germany, 51% of that is done out of renewable. So these massive things, energy crisis, probably behind us. So the component of energy, no more in inflation. We don't believe in this long-lasting phenomenon of wage inflation spiral. And we see the end of the Great Resignation in the US, a kind of normalization. Unemployment is stabilizing, slightly up in the US, slightly up in France, in Germany, in Spain, and so on and so forth. So we don't see much of a spiral here going into inflation. And even food prices are starting to go down. And service prices, since wages are not accelerating, they are still quite higher than before, but a bit below where they were last year. So all this taken together, we think inflation should behave not nicely, but going towards this goal of central banks. So what about the central banks? This year, 80% of the central banks we were monitoring have been hiking rates like mad, like never before. Again, this 2023, think of that, 450 basis points by the ECB in 10 sequences. Never seen before. But going into 2024, the vast majority of central banks will be cutting rates. So this is a pivot, and not only a stabilization, a plateau. Central banks are going to cut rates quite nicely and massively next year. Not as fast as they go up, but clearly this is a new trend that we have to think about. So lots of consequences for market, re-steepening of the curve, probably a bit of a pressure on the dollar and so on and so forth. But clearly the tightening conditions that we have seen this year are going to reverse somewhere down the road. And we are going to discuss the timing, because the question is not if if central banks are going to cut rates. Again, we have already more central banks in October and November to cut rates than to hike rates worldwide. So this is it. We are here. The pivot is starting now. 2024 is going to be the name of the game, probably, of this new environment of lower rates going forward. So this is good because Europe probably is going to resist. We are going to discuss Asia and China, a slight deceleration, but quite too potential. US has every reason to decelerate. We will going to see that. So overall, it's a soft landing scenario, deceleration of inflation, and central banks should be cutting rates. So I stop here to discuss that with my colleagues, but clearly, you see, it's a bit maybe optimistic scenario, less, I would say, bold last year when we were very alone in this scenario of no recession. No recession next year, slight acceleration next year because less inflation, more purchasing power, and central banks reversing the cycle with cuts all over the world, with the noticeable exception of Japan, probably Russia, Turkey, but the whole world is going to probably to see central banks having less tightening and accommodative or more accommodative story. Let's discuss that with our expert first on this first panel on macroeconomics. I'm very happy. So I'm still very happy to welcome our guest and to discuss. We're not too optimistic. So ladies first. So we have the pleasure, as usual, to have our chief economist for Asia, Alicia Garcia Herrero. She's joined by our two new economists from the US. Christopher Hodge is our new chief economist for the US economy. Is coming from the Federal Reserve. So lots of insight here. Joined with Jonathan Pingle, our economist on the US, and our Dirk Schomacher, our chief economist for Europe, to discuss all these topics. I guess I want to start with you, Christopher, because 2024, this is it. We are back to election in the US, so lots of things can change. So maybe starting with the US election is very popular discussion all over the world, but especially in Europe, I guess. What will be making the difference? And we see Trump well in advance in polls, so maybe we'll have a second round of Trump-Biden. What are the changes we can expect if it is Trump or Biden?
Well, the changes are going to be a lot, but particularly on trade policy, there's not a really large gap between Trump and Biden. Both are protectionists, both want to prioritize job growth and production in the US as opposed to expanding trade partners. The tariffs that were implemented by Trump during his term were extended by Biden. So bipartisan being hawks on China is the norm now, and that is expected to continue. There are two primary gaps between the two. The first is purely cosmetic, and Biden is more polite about being a protectionist. The next is that Trump has proposed a 10% tariff across the board on all goods, which would be the most draconian trade policy that either he or the current president have done so far.
And what about the Inflation Reduction Act? It was we see a great success in terms of investments within the US, but as well from abroad, and lots of sequences. I think we are talking about 400 billion or more of investment so far in the US. What about the IRA? Because we heard about Trump saying, I want to reverse, that the electrical vehicles are against the American culture and so on and so forth. What about the IRA? Is it going to continue, or this is going to be a full stop of this investment spree that we see in the US?
I think it's going to continue for a couple reasons. First of all, it's made up primarily of carrots and sticks. The carrots are in terms of tax credits that are offered. Trump is not going to take those away. The sticks he probably would, but a lot of the investments that have been born from the IRA are born in conservative places. So I don't think that Trump is going to do a full reverse of the IRA.
Yeah, we see them. Texas being one of the big users of IRA, despite all this sanguine speech about against the IRA. big question that we have as well in Europe, and we are quite happy to have you, the US economy, in our camp. We feel that the US economy is getting more and more European as far as debt is concerned. And we see all this, quite a eye-popping trend where we see obviously Russia, but no, more than that, probably the Chinese selling treasuries, Saudis selling treasuries, a kind of a not de-dollarization. We're going to talk that with Nordin on the market side after, but a lot of sellers of treasuries, and at the same time we see a big spike of issuances in the next years. How do you see the debt dynamics in the US?
Well, they're not good, and it doesn't look like they're going to get any better anytime soon. We have deficits at about 6%. We'll have that for 2023, 2024, and 2025. This increased issuance will probably only go up if Trump wins. Conservatives will probably take Congress in 2024, and if they do, the tax cuts that were implemented in 2018 and are set to expire in 2025 will be extended. That would add $3.5 trillion to debt overall. And we think that as 2024 progresses, if it looks as if Trump is going to win, the premium extracted from buyers is going to be higher.
Thank you, Christopher. Maybe last question for you is around the real estate market, because we have seen 2023, with this hiking cycle by the Fed, again, never seen before. Well, last time they have done that, it was 40 years ago. We could have expected a lot of cracks in the economy, and the only crack that we have seen is probably on the real estate with some tension here. How do you see the context of real estate, especially in the commercial in the US?
Sure. Well, small banks hold about 2/3 of all of this debt, and they have this large exposure to these office space. The space being filled is not going up, and this is going to hurt bank profits. It's going to hurt bank earnings, and we think that this is going to have a pretty big effect on credit, which is one of the primary reasons that we have the Fed cutting starting in Q2.
Yeah, so it's one of our calls to have the Fed cutting rates quite quickly on that matter. And we see as well the labor market normalizing. So maybe a question for you, Jonathan, because as a famous Nobel Prize said, that the US consumer never dies in a way, and that's probably explaining the big resilience of the US economy. So is it still gas in the consumer tank in the US?
So, I mean, it looks like there's still a little bit of gas in the consumer tank. Since the pandemic, we've seen really historic gains in wealth. We've seen real consumption get back onto its pre-pandemic trend, and the U.S. has added over more than 3 million new jobs. And alongside these wage gains that have come with it, the U.S. consumers have built up an incredible amount of excess savings. We estimate 2.1 trillion. And while these excess savings are immense, we don't think they're inexhaustible. So we're estimating that by Q2, they'll be running on fumes.
And where does it coming from, this excess saving? Because if we see unemployment rate going up, we were 3.4, we are now 3.9. I don't know where we expect the unemployment rate at the end of next year, but clearly, where this excess saving is going to come from if we have this normalizing of job market.
Yeah, so I mean, we do see a normalizing of job markets. By the end of 2024, we're expecting the unemployment rate to get up to about 4.6%. But regardless of that, a lot of these excess savings mostly came from the CARES Act, American Rescue Plan, and a lot of these government transfers. Though that's not to discount the amount that have come from the wage gains that we've seen over the past year and a half. However, we're running out. We estimate that as of last month, the U.S. households have spent about 1.9 trillion of that $2.1 trillion that we estimate in above trend savings.
So what about or in this context, the GDP growth in the U.S. and inflation? To give some numbers to our viewers.
Yeah, of course. So we expect to see inflation continue to decelerate for a number of reasons. On the core goods side, we've seen supply chains normalize, and we expect that to continue. From the core services side, we have pretty good leading indicators of rental inflation to continue to fall, and we expect that to bring down overall core inflation, core CPI, to 2.2% year over year by December of next year, and core PCE to 2.1%. And by the time we're getting Fed cuts in May for our forecast, that means that we have inflation running at about 2.6% or a little bit under, which is on track with what we see is consistent with FOMC speaks on it.
Thank you, Christopher and Jonathan. Maybe to jump to China, because there are lots of noise still on this trade war going on. Like Christopher said, Biden is not that different compared to Trump in this regard. It's more cosmetics and wording more than acts. What about China in this context, Alicia? And please do not forget to ask questions. We'll have a Q&A session for US, Europe, and China after that. So, Alicia, what about China? Well, this year it was quite close to our goal of 5%, so congrats on that. What about next year?
Well, it's quite easy because every year is slightly less growth for China because we are in a structural slowdown, structural deceleration. So we just have to lower our projection a little bit and we'll get it right because even if, which is the case, there is an increasing buy for stimulus in China. So we have had $1 trillion on the fiscal front, half of it just to basically cover the issuance that is coming due from last year. But there's a little bit more of fiscal stimulus. We expect a little bit of a cut, maybe 20 basis points, not too much because the Fed is coming to the rescue in a way in terms of divergence of interest rates. But we'll see a little bit more on the monetary side. But what is really happening, which is big, is basically the PBOC boosting credit, whether it's through a new program to save real estate developers. It's a big program. It's kind of called 50 White Horses, but it doesn't really matter. It is all about saving those that were, on the brink, whether it's Country Garden, whether it's Banque, big developers, and that is filtering through the economy. So we are seeing a lot of credit basically being granted by banks. And that is enough, surely, to stem off the deceleration to a level around 4.8, something like that. So it's going to be quite good, given the circumstances, notwithstanding, that's the point, of course, Chile win coming from, potentially from US elections, but also, to be frank, from Europe. We have a summit this week in Beijing, and it shows that the Europeans, we basically, and our officials in Brussels, are starting to get pretty nervous about China. And Europe remains today the largest export market for China, the euro area, I mean the EU as a whole. So this is, it's getting hard, but I think because of the stimulus, all in all, I think China will grow around 4.8%, and the rest of Asia will do better than China. So
what you're saying, Alicia, is that we think that China will be more domestic-led economy going forward. So two questions: what will be, in a way, the impact on the world, and how much China can do without the world, in a way, because we see that Xi Jinping policy are much more into, I will say, sovereignty, resiliency of the economy. How much China can do without the world if we start to see the world more and more on a regional trade basis?
Yes. So basically, China, the question actually, to rephrase it, would be how much China can do without us, meaning the US and Europe, because the rest of the world is basically on a different stance. China is using the RMB to entice additional imports from the rest of the world. China is using trade deals. China is using the Belt and Road Initiative. China is using lots of stuff, the Global South, basically, to support exports from China. Still, exports are growing negatively. They've been growing negatively for quite some time, minus 6% or so. It's mostly about us. So what's going to happen is that China knows that exports are going to continue to be very weak to certainly the US, much more than Europe. We want to de-risk, but we might not be able, and I want to hear from Dirk, to do so quickly. But the US is full win on that. And I think that means that they need to rely on other markets, but also they need to continue, and this is key for us, to reduce imports from us. And that's the localization strategy that China is putting forward. So EU companies operating in China, German companies, I just came back from Beijing, clearly are localizing their activity, which means cutting on suppliers from Germany, from the rest of Europe, and that's a problem for us. So who has the biggest problem? We can get on that later, but it's not only China's problem. It becomes also our problem as our companies localize there.
So I was about to ask you a question about this huge rebalancing between China and Asia. We see lots of investment from abroad coming less in China, but more into the rest of Asia. I think the FDI from the US has been divided by 2. We see that Canada, Mexico are now ahead of China in terms of trade. We have a question, which is a good one, I think. What is the probability of a military tension between China and the US with the election upcoming election in Taiwan?
Right after the election, you mean? I hope it's very low because I'm based there most of the time. So I bet, I use my own bets to argue that I don't think there will be a military event. Maybe tensions are different, yeah? China will surely start military operations again right after the elections because the DPP, the incumbent, is basically running first on the polls, and that's going to mean a lot of tension. But I don't think we are in a military event. I don't think we are, which is very important for our companies and banks here and in the US, at a point of potential sanctions on China for those military operations. We have events already happening, yeah, in the Baltics with a submarine cable, and the Finnish Ministry of Foreign saying that this is a China, purposely done by China, and nobody has come up with sanctions. So you see that the ability to sanction China is so low that I would basically make everybody listening to us feel rather comfortable on the scenario in 2024. But as we move on, I think that things could be much harder.
Thank you, Alicia. We have some more questions for the Q&A session after that. Maybe talking about tension between China and Europe, or do you see Europe, I think Alicia was right in mentioning this more assertiveness of Europe is starting to do things we see with electrical vehicles, with wind. We see lots of action taken by Europe of late. Or do you see this relationship between China and Europe moving forward?
Well, there's certainly a reassessment going on. There's the sense that Europe was naive when looking at China and trading with China, not seeing that there might be some kind of hidden agenda. And certainly the pandemic has sped up that sentiment change in the sense it showed there are dependencies, an area where you don't want to be dependent. And the green transition obviously is another area where if China doesn't play along, it won't happen, at least not in the way the European wants. Solar panels, wind turbines, all that. So there's a clear understanding this is in a position where Europe has weaknesses and it doesn't want to stay that way, or that position shouldn't be that way. So there's going to be gradual change under decoupling, but at the same time, Europe's probably going to be quite a bit more constructive than the US, certainly under a Trump administration, because the dependencies at the same time are bigger. So it's going to be, that would be my base case, a gradual process.
And going to Europe now, Dirk, why at the end of the day Euro did not fall into recession? That was our scenario. So why it did not happen, and why we expect accelerating growth going into next year?
I mean, a bit of luck certainly helped, but I guess the fact that Europe was able to reorient its gas supplies very quickly to Norway or LNG. That's what we expected to some extent, but in the end it was surprisingly how relatively smoothly it went. So that helped, obviously, that we were able to replace Russian gas with others. And the fact that the corporate sector was in pretty good shape, i.e. that the corporates until recently kept investing because the profit growth was very strong. The weakness was the consumer, which was understandably, given that inflation went up dramatically, implying that real income went down. But that's also the story then for next year, because real income is now rising quite sharply as inflation is plunging. That will spur consumption, which had been a drag over the last couple of quarters, and that should then pave the way for a moderate reacceleration of growth.
And if you look at the two biggest economies, we're talking a lot about what's going on with the debt break on Germany. We talk sometimes of the sick man of Europe again regarding Germany, but again, never underestimate the US economy, never underestimate the German economy either, in my view. What about Germany and how it compares to France, which was quite doing okay during this COVID story, but how do you see the two economies moving forward?
Germany will re-accelerate as well, but it will lag the rest of the euro area. It is to some extent a segment of Europe, and the reason is that these structural changes hit Germany more than other places. So the dependency on China, all else equal, is bigger. There are more energy-intensive industries in Germany. The car sector, which is undergoing obviously a very important transition that is hitting Germany more than other places. So the list of challenges is just longer, but nevertheless it will recover. And well, France faces some of these challenges too, but less so. So we think that growth in Germany is going to be 0.7 next year, and in France maybe 1.2, meaning half a percentage point more in France than in Germany. So that still qualifies then as the relative sick man of Europe, but. Going back to the 90s, the situation was a bit more dire than back then, I think.
We talk a little bit about this energy story. Maybe a word on the green transition. This is a big thing in Europe. We were talking about Germany. Like I said, 51% of electricity now down with renewable. A country like Portugal, for some days, has been producing its electricity 100% with renewable energy only. So yes, this is possible. It's not lasting long, but clearly the transition is impressive. How much of that is into Europe scenario?
Well, it's progressing, and that's good news, but we're not at the end of the tunnel here, certainly not in Germany. So, for example, over the last couple of days, the contribution of solar to electricity was zero.
Surprisingly.
Given that we have a lot of solar panels these days, that's not good news. And the way the whole energy transition, at least in Germany, was handled was clearly not the way it should have been done, i.e. shutting down nuclear, but it is what it is. But it implies, unfortunately, the sequencing, as the government introduced, that energy prices will stay high in Germany, and that's weighing on the economy. To some extent in other countries as well, and we have a European electricity market. So there are challenges. They're getting smaller over time, and eventually renewable energy will be cheap. But you as well need a grid. You need a lot of other investments. That is helping to some extent. We see the investment spending is because of that as well strong. But it's also a headwind. So we'll have to deal with it, and it will take a couple of years till we're really where we want to be.
And inflation is probably a pivot point in our scenario because we think it's going to go down, not nicely, but steadily and slowly maybe, but steadily towards the 2%, above 2%, but probably not back to where it was before for sure, but not that far from 2% in 2025 in our scenario. I think we are 2% in 2025. So what about this inflation? How confident are we that inflation still is going to decrease next year?
Well, certainly I was surprised by how quickly it came down in touching distance to the ECB's 2% target. The one factor that worries me somewhat is wage growth, which is pretty strong still, around 5% in Q3. At the same time, corporate profit margin have been so high that there is margin compression as one outlet of wages not translating immediately into higher inflation. So yeah, I think we stay around these levels. It certainly opens up the room for the ECB start cutting. We think that it'll take a bit longer. Only in June will the ECB start cutting, but we could be in March, April already at 2%. So I guess this was it. The ECB has won the battle.
And talking about ECB, maybe last question on that, or what about the ECB going forward? I think we have a scenario quite not aggressive, but I think consistent with this view on inflation.
Indeed. If it's true that inflation will stay around 2% in the first half of next year, then of course they have to cut at 4% for the deposit rate. They are clearly in restrictive territory. They want to get back to neutral. Let's say that's around 2%. So you still get 200 basis points of cutting. And if you're at target, there's no reason why you shouldn't cut. So we think it takes a bit longer till they fully acknowledge that. So June, but then they will cut every meeting this year, meaning a total of 125 basis points of cuts. That's our forecast.
Thank you, Dirk. We have a few questions. I'm going to try to make a selection of that. Maybe a question which is both for China and the US, Europe, we get used to that. But again, it's about debt sustainability because we see a lot of now China or US, like I said, are getting more and more. We are all Europeans in a way getting that. We see a lot of expenses in China. You mentioned that, Alicia. What is the risk of the debt issuance in China and again, the supply-demand story?
Well, let's start with a few numbers because they're not as well known as for the EU and the US, simply because we don't have those numbers. We need to dig them. And that is public debt in China around 100% of GDP. So that's basically nothing to envy to Europe or the US. And secondly, around 300 for overall debt. Now, all of this looks horrible, especially if you consider, you know, where China is standing in terms of income per capita. But it has a trick which makes it easier, which is that it's totally domestically held. These are Chinese savings. But this means that we're not in a crisis scenario whatsoever or rates spiking because nobody's holding the debt. That's out of the question. What is not out of the question, and this is Japan, is that this debt will bring down structural growth even further, and that is Japan. When Japan had $12,000 per capita, as China today, a public debt, which happens to be over 230% today, was only 40%. So you can already tell that China's debt will not stop at 100. And in fact, we're competing with the US here in China on the public deficit overall. Fiscal deficit, everything included, is around 12% of GDP. So there you go.
But what is striking me is that we see these huge new investments going forward from all over the world in green transition, in military spendings, unfortunately, on digitalization, semiconductors, blah, blah, blah. So everybody is going to compete for investors, for saving worldwide. So we are not going to be able to import anymore saving from one place to do our own investment. So we have this debt sustainability story. So how do you see that going into the US, Jonathan and Christopher? Because I hear that I think it's $2 billion a day, the interest cost for the US federal debt. So how concerned are you guys on the debt situation of the US, Christopher and Jonathan?
Yeah, debt is driven by entitlements and defense, and there's no appetite to cut either now. I really can't see that happening because really the only time that any party wants to cut debt is when they're not in power. So this is a structural problem, but I do think that Biden is an institutionalist at heart, and I could see if he does win, starting progress towards trying to address these issues. Maybe a bipartisan commission on trying to address some of these structural problems, but currently there really isn't there isn't a whole lot of
tension in the treasury issuances.
Yeah, exactly.
It's so far so good.
Yeah, and if you look at just interest outlays that we're expecting from the CBO over the next couple of years, we're going to see some very large revisions from the CBO's next estimates. And on top of that, the Fed used to be remitting all of their earnings to the Treasury, and that's currently being piled up into a deferred asset that we're not going to see Fed remittances to the Treasury over the next 5 years at least.
It says a lot, but we were talking about debt in China and US ahead of Italy. So it says a lot about the current situation. What about, I don't know, Europe? I'm thinking of Italy, but not only.
I mean, the one thing you can say about European debt dynamics is that usually the markets are a lot more vigilant about all this. So we do have a correction mechanism. You have one country, a big country, let's call it Germany, where debt is very low, and that kind of provides the anchor. And if the others go too much away from that anchor, well, then the markets step in and the spread goes up, and usually that has some disciplining effect. That's not what we see, obviously, in the US, because who's going to discipline the US in the same way, like, say, Italy's being disciplined. So I guess that makes Europe all overall quite stable on that front.
Question for you on the, sure you will not have not this question regarding the Karlsruhe on the budget issue. How do you think Germany will resolve its situation on the budget issue?
Well, there are a couple of ways this could go. Unfortunately, the most realistic one is that fiscal policy will just be quite a bit tighter. So the finance minister says 17 billion are missing next year. That's less than half a percentage point. So that by itself is not such a big deal. But nevertheless, it's missing in parts where we actually need it. So I'm not a big fan of the way the debt brake is set up. You can argue fiscal rules are good, but the way the German one is set up, I think, was a fair weather exercise. It's not really suited for the times we're in, unfortunately.
Thank you, guys. Time is ticking up. Thank you for being there. So if I summarize the macro picture so far, what we see is a deceleration of the US because the US consumer has to stop spending at some time, as Jonathan was saying, and as Christopher was mentioning. We think the US GDP growth should be divided by 2, but still on a positive sequence, around 1.2% going into next year. Europe should be reaccelerating, on the contrary, because of its decline of inflation, which was denting more Europe than the US in terms of energy crisis. So Europe should be close to 1% next year. And China, I think, is going to decelerate, but around 4.5, even a bit more than that next year. So maybe on the longer run, we are more cautious on China. We think it's going to be close to maybe 3%, maybe less than that in the next decade. But for 2024, the situation, if you look at the macro picture, it's not a recession. It's well, pivoting to a new normal, I don't know, but clearly not a Goldilocks either, but deceleration toward this kind of new normal. Thank you very much for joining us, and now we move to the market session. So welcome to this session dedicated on the market as a whole, in a way. So I'm very pleased to be joined by Thibaut Cuillère, our head of sectors research or real assets, Joël Hancock, our analyst on oil and commodities, in a way. Benoît is our red specialist, coming from the central bank as well. So lots of interesting discussion. And Florent Pochon, our head of cross-asset strategy. So what we say is that maybe this is a year of the bond market, which is kind of an obvious story. If we think that central banks are going to cut rates like not like mad, because once again, the way up has been probably faster than the way down. But clearly, like I said, 80% of the central banks that we see, and so the vast majority of central banks are going to start cutting rates. And like Christopher was saying, and Jonathan, in the US is going to start at the end of the first quarter. Same for the ECB in the second quarter. So it's coming fast. So it's going to be the year of the bond market. But for this to happen, maybe we can start with you, Joël. For this to happen, we need to see the scenario, which was your scenario last year, and well done on that, to see no big spike of energy prices. So what about oil and gas prices in 2024, Joël?
Yeah, sure. I guess we can start on European natural gas. So looking at storage inventories at the moment, we're about 97%, which is a record for this time of year. So this is far more than was anticipated prior to the start of the winter. So we've been able to conserve gas stocks a lot more easily, I suppose, than was anticipated. So what's behind that? We have, I guess, both factors on the demand and the supply sides. So on the demand side, going into the winter, there was concern that those behavioural shifts that we saw in 2022, with consumers stepping back, I suppose, and limiting their own consumption of natural gas, loosening, perhaps some behavioural fatigue. That hasn't actually happened. And when we look at the relationship between consumption and temperature from October through November, compare that to the 5-year average pre-crisis, we're currently around 8 to 20% lower than would be anticipated. So clearly those behavioural savings are remaining sticky. On the supply side, LNG imports remain very strong. So demand from emerging Asian markets is still very weak. Mature Asian markets that could outcompete Europe for these LNG cargoes, flexible cargoes, again, relatively weak too. So broadly, both supply and demand side factors are contributing to that higher storage level. And broadly, any premium in the gas market is based on a view that you might be running out of storage. So 2 months into the winter, still 97%. I think it's justified that we've seen prices come down both on the spot basis, but also on the longer curve as well.
And what about oil? We have seen this move by OPEC with not much of an impact on the oil prices. What do you make out of it?
Yeah, so I mean, OPEC cuts broadly, you'd say that they can support oil prices, but the market is really asking the question, why is OPEC cutting so much? So on paper now, they're cutting about 6 million barrels per day. So when we look at non-OPEC supply growth in 2023, very strong. So the US, about 0.9 million barrels per day, Brazil, 0.3, 0.4, Iran, 0.5 as well. So broadly, OPEC has had to cut to make room for these barrels. In 2024, looking forward, we see another strong year of non-OPEC supply growth again. So again, US, Guyana emerging as a kind of petroleum province as well, 0.2 million barrels per day. So it'll truly be about the strength of the demand side, about whether OPEC can unwind these cuts. And the market's current assessment is that OPEC might find it difficult to actually unwind those cuts. So that spare capacity will be maintained, and that's going to keep capping oil prices.
And question maybe, do you think that the OPEC can afford to let prices go up that much? Because I think if they do that, they might take the risk to accelerate the green transition. Think of that this year in 2023, when you invest $1 in fossil fuels, you have twice as much invested in green transition, in clean energy. So I was mentioning Germany, Portugal, etc. Portugal is not using only solar panels like in Germany, but as well hydraulic, biogas and wind. How much of this green transition, which seems to be accelerating like mad and everywhere, including China, China is massively investing in green transition, how much of that is impacting the ability of the OPEC to influence the oil market in a way?
Yeah, no, I think it's a really good question. I think OPEC's play is to be the last producers standing in terms of the oil market. So effectively, their, I guess, share of the market is on a kind of decade basis seen as increasing. So I guess it would be the European majors who see their production decline and shift into more, I guess, transition fuels. But broadly, I suppose OPEC's play, exactly as you say, would be to not have those kind of aggressive price spikes that could then result in, a broader accelerated transition, I suppose. And that's exactly what we saw in 2022 with the European gas crisis, massive increases in solar investment, wind as well.
And we have this kind of a surprise because in 2023, what we have seen as well is a reacceleration of the shale oil from the US with the number of rigs going up again. And it's back to the Trump question that he wants to reopen some federal land to oil production. How much of potential this story has next year into your oil scenario?
Yeah, broadly, US growth really surprised, about 0.9 million barrels per day in 2023. Consensus was more like 0.5 or 0.6. So that outperformance predominantly was due to, I guess, efficiency gains in legacy basins. Broadly, we wouldn't see a major increase in production due to I guess, the unwind of some kind of restrictions on federal land drilling. We kind of looked into that before. We don't think it would be a huge driver. The biggest factor really is whether the efficiency gains that we saw in 2023 can be repeated. We don't think so, so we see about 0.3, 0.4 million barrels per day year on year, but still pressure in OPEC with their supply cuts.
Since Joel has been the best forecaster for oil and gas on the Bloomberg consensus for quarters now, I have to ask you the question for 2024, just to have it, everybody gets that in mind. What are your forecasts for oil and gas 2024, Joel?
Yeah, so for Brent, we see $84 per barrel, average of the year, ending 2024, 82.
I mark that down now for next year.
And then for TTF, so European gas, about 41 average euros per megawatt hour. We see prices actually moving lower in the summer, so Q2, Q3, we could see lower of about 30 euros per megawatt hour. So clearly far more accommodative than last year and the year before.
This is a good transition to European situation and probably the market and the bond market, especially in this regard. If Joel is right and it's more supportive, this energy story, and inflation goes down, as we mentioned with Dirk Schumacher just before, what about the ECB in this context, Benoît Gérard?
Well, the ECB is expected in our scenario to cut rates at 125 basis points in 2024, starting in June. I think the inflationary outlook warrants it and supports this case. I mean, this is a bull market for bonds, of course, limited by the fact that we are reaching the neutral at 2%. That's our call. So it's limiting a bit the bull market. It's not a contractionary environment, so a limited bull market, but still a bull market on bonds. On the Fed, we think this is broadly the same story, converging to the neutral, starting in the April-May meeting for 150 basis points of rate cuts in 2024 for the Fed.
So does it mean a re-steepening of curve? Is it supportive for the bond market in Europe, in your view?
Yes, we should. You should see some re-steepening, limited one, obviously, because there's some term premium considerations rebuilding with the supply issues in the US, notably, with central banks shifting and lowering their footprints on the bond markets. So this should help term premium to rebuild somehow. So we see both curves going positive in 2024. Crossing the zero line in the middle of the year, and we should end the year at 20 basis points on both swap curve, 20 basis points for the 210.
And for the Bund, what are your target for the Bund and probably the swap spread, if you can touch on that?
Yeah, we expect for the Bund 2% target for the end of the year. And in terms of swap spread,
So end of 2024, right?
End of 2024, of course. So a limited bull market again. And when it comes to the swap spreads, we see the German swap spread coming back to a regime closer to what we saw before 2020. So tightening of swap spreads closer to 50 on the Schatz, for example.
We have seen some slight pressure from ratings, France, Italy, etc. But big surprise of 2023, again, in this context of avoided recession, central bank hiking rates, so putting a lot of pressure on the debt sustainability. What are your views on the sovereign spreads going forward?
When it comes to spreads, we can talk two different stories between the BTP, the Italian debt, and Spain. So Spain is reaping the benefits of fiscal consolidation, fiscal discipline. So we expect a slight consolidation of the spread. When it comes to BTP, we see more like a stabilization around current levels, maybe a slight widening going into the year end. One reason for this is the possibility that maybe the ECB will miss something on the PEP. And if the ECB doesn't really convince markets that it can use flexibility in a proper way, that's a tail risk scenario. That's a risk we highlight, but still the baseline scenario is unchanged spread on BTP around 180.
So globally, what are the main strategy we want to look at in 2024?
The main strategy, of course, would be long duration bonds. Maybe
it's not too late because we have seen a fantastic November, for instance, on the bond market.
It's not too late, especially in the US, where you cannot discard the tail risk that maybe the Fed, should something break in the economy or in the plumbing for the financial markets, maybe the Fed should supercharge its rate cuts with some precautionary rate cuts. But still, long duration bonds is not too late, and maybe spread positions long. Carry positions.
Thank you, Benoît. So maybe moving to credit with Thibault. It's been I would say popular idea as well to go back to credit. Obviously, if it's a bond market year, if the year of the rebound in a way, it should be positive for credit. Where do you see the most value in the credit market, Thibault?
Yeah, and first of all, and as you can see from that chart, actually, it's interesting to see that clients tend to believe that corporate credits will be the place to be in terms of investing for 2024, with almost half of our clients believing that they offer the best value among the asset classes. And we actually tend to believe that it will be the case too, for three reasons. The first one is that banks are starting to tighten less their credit conditions towards corporates, either in Europe or in the US. This is coming from the bank lending survey and the senior loan survey. And we expect more loosening to come next year. Second thing is that default rate for high yield has moved already up by 3 percentage points for high yield since the end of 2021. And we think we are very close to the peak of default rates now, probably from 5%, while we are at 4.5% for global high yield default rate today. So that will be a good news in terms of trend. And finally, technicals are going to be supportive next year because we expect a lot of credit inflows thanks to lower rates, as Benoît mentioned, actually. So we would expect something like 30 billion of net inflows in credit funds next year in Europe. And that will be that will more than offset actually the net supply, the increase in supply we expect for corporates next year. That will be probably around 25 billion, given the fact that there are still reduced needs of financing coming from M&A. The M&A is still very depressed, 1/3 of reduction this year compared to last year. So that will be the last factor of support.
Any concern about this rising default rate? Because in this deceleration and hiking cycle, we discussed the regional banks in the US, the real estate story in the US. That will be after my question on you. But first thing first, on this normalization of default rate on the credit market, how much of a story is it in 2024?
Well, as I mentioned, actually, we have seen already a very steep increase actually in default rates this year, coming particularly from the change in policy from central banks actually that have moved the interest coverage ratio much lower for most of the high yield company. Second thing, as you mentioned, is that we have seen a couple of defaults obviously coming from specific sectors such as the banking sector and real estate. We might have some other bad news coming from real estate, and I'm sure we're going to talk about that later for next year. But the good news is that as banks are starting to loosen their credit conditions towards corporates, that will be beneficial from the trend in default rates and will probably plateau around 4.5 to 5% for next year, which at least is a good news if we plateau there.
Yeah, it's back to, again, a new normal, just to try to circle in
Exactly.
the main topic. I was looking at the numbers in France, 52,000 bankruptcies so far this year, which is exactly the level of 2019 and well below the average of the previous decade. So it's back to normal, but it's not a catching up effect so far, if I hear you well. Maybe a question on the real estate market. I see a lot of question around that. Well, is it if rates are starting to go down, can we expect a rebound of real estate, or is it too optimistic story?
Yeah, so that's interesting because definitely we will have differentiation between the various asset classes of real estate, i.e. credit real estate, equity, and real asset. Real asset will continue to be definitely impacted by higher rates because they have a lag in terms of the impact on the values coming from rates of 6 to 9 months. So we will see more depreciation for the values of real estate on the real estate market definitely next year. The bottom will be reached probably between 25 and 30% down in terms of value for office and sometimes for residential market, at least for institutional, compared to the values that we have reached end of H1 22, just to give you some ideas. So this is for real asset market. Now, talking about the credit markets, the credit market is a bit ahead of that because companies are starting to struggle with the refinancing and sometimes their portfolios in terms of the risk on loan to value make them in a compulsory situation to do some capital increase. And as such, the credit market is starting to benefit from that. As we have seen at the end of last year, we think there is more good news coming on the credit markets, particularly for logistics and retail real estate that should outperform. While the equity is probably going to suffer a bit from risk of capital increase coming from residential specific names such as Amsterdam, for instance.
Thank you, Thibault. So if this is, maybe I turn to you, Florent, on the asset allocation in this regard. If this is a year of the bond market, what about your view on asset allocation in this context? Which are the good assets to look at?
Well, we discuss it. Maybe I can put a bit of number on that. So basically, yeah, I think we expect positive numbers for both equities and bonds next year. So it's going to be a better year for diversified portfolios. So if we start with bonds, we discussed with Benoît already the views we had. So obviously, we think that there are many arguments for which it's going to be the year of bond. You have higher yields, which means that you have higher carry, more caution to duration risk, and you have more potential to go down, especially in the US. So if you put numbers, then again, we think the US will outperform in terms of total return. For the bond, we have at least 250 basis points in terms of carry plus roll down for the US curve, and you have up to 6 to 8% of price gains. So it makes something like a double-digit gains, potential gains for the US Treasuries for high duration treasuries. So it's a lot. And for credit, we could have also higher total returns with almost, let's say, 400 basis points of carry and also some duration potential gains, especially on the IG in the US, which has long duration. So you could have, again, double-digit numbers in terms of total return for bonds in the US especially. So we have to overweight US bonds versus European fixed income. I think the other point which is noteworthy is that it's not only in terms of valuation, but also the relative valuation between equities and bonds makes it more compelling to go to the bond side, especially if you look at the earning yield of the S&P, it's 4.5%, so it's below what we have on cash on the US markets, and it's really aligned with the 10-year or 30-year bond yield. So again, you have somehow a no-brainer between something that is less risky in terms of coupon for bonds versus equity risk. And the last element, which is good also, it's the correlation, the equity bond correlation, which will make, again, the global gains for diversified portfolio better, because we believe that as inflation risk is decreasing, then you're going to have a normalization of this equity bond correlation. It has been extremely positive this year. We think it's going to normalize to our lower level, so it will going to make portfolio diversification more efficient.
Thank you, Florent. And we ran a survey with you lately. I don't know if you have seen some slides, and we published it. And 1/3 of the answer looking at the asset allocation for the next 6 months was on cash. So is it something better to do with the cash than to keep it on money market? I wanted to ask you the question on the equity market, because again, this is an obvious trade to buy some bonds when we are in an environment of cutting rates. What about the equity market, Florent?
Yes, so the equity were decently positive again because for two reasons. First, we don't see hard recession. So historically, as you can see in this chart for the S&P, I mean, if you avoid recession, it's going to be up market. So especially in soft landing side, you have 22% of gains 1 year after the last cut of the last hike of the Fed. So you could have a very strong bull market on the equity side. This is not what we expect. But if you have no recession, you have a floor. And second, if you have no inflation and if inflation is decreasing significantly, then the central bank puts will be back on the table. So I think that the level of real interest rates will go down. This will make potential PE expansion possible, at least at the margin. So if we look now at potential at fundamentals of equity, we are not as optimistic at the bottom-up expectations. We think that there's limited potential of gains. The consensus, for instance, is expecting EPS growth in the US of 11% and 6% in Europe. We believe it's going to be lower, more on 6% for the US and 3 to 4% for Europe. But if you add to that a couple of percentage points of PE expansions, we're going to have, again, from 5 to 10% of gains in the equity market. So a little bit lower and more risk than in the bond market, but still a decently positive outlook for equities in our view.
Last question on my side. Please do not hesitate if you have some question before we close up this session. Florent, last question. What are the main thematics you want to look at in 2024?
Well, obviously, tech will remain on the front line. So we've been seeing stratospheric gains, skyrocketing stocks. I still believe that it's going to be something worse to play. Why? Because techs will be immune to the slowdown in the US. It has a lot of cash.
To quality now.
Yeah,
magnificent.
I mean, it has a lot of cash. It has growth opportunities that are significant. Again, if you look at the EPS growth trend, it's 15% per year, so it's strong. Now, you have to play that and avoid somehow the concentration risk. Again, if you look at the NASDAQ 100, 60% of the risk of the index is carried by the 10 largest names, which are including the Magnificent Seven. So there's a lot of concentration risk, but still, so I think you need to play it. And there are two ways you can do that to play techs without and decreasing the risk of concentration. First, you can use equal-weighted portfolios and indices. This is good. And also, you can use also defensive strategies. For instance, on our structuring side, you have developed some hedging strategies on techs that enable you to capture the tail risk of these sectors. So I think this is typically something to do. Something I would be cautious also, we talked about slowdown in the US with Chris and Jonathan. I think I would be cautious on the cyclical versus defensive. I think the cyclicals have been outperforming very strongly in the US. So on that side, I'll be cautious. And I think that if you want to play the good surprise in the US economy, it's better to take some optional strategies on small caps, which are extremely undervalued in case of really soft landing or rebound in the US economy.
On this regard, we have a question I think is very interesting because we have the question about have the central bank gone too far in the tightening cycle? But then we have this question from Julien from Bloomberg asking, well, is it not too optimistic what is pricing in the market? So is the rally, we see a bit of a pause in the rally because all this anticipation from the Fed, are they going too far in your view?
On the bond side or on the equity?
Well, on the impact on the equity side of this bond pricing.
Well, again, I think, it's obviously that the real rate has been decreasing. So this is something you have to look carefully, and that's one of the risks for techs. If we have a repricing in bonds, then of course the tech are super sensitive. They have high duration, so you may have again an adverse impact on technology stocks. But again, I think you have this structural trend of growth and profitability that makes them immune versus the US cyclical slowdown. So I think it's still good, but it doesn't mean you have no risk, and that's why I think that it's also good time now to engage in some kind of tail risk or hedging strategies on the tech and also on the market. And especially now, if you look at the low level of skews and vols, it's very interesting to engage now in this kind of defensive strategies.
Anyway, we cannot have an asset allocation discussion without saying that we need to diversify. So thank you very much, guys. I think we are running out of time. So thank you very much. So maybe a word of conclusion on my side to say that if you look at the macro picture, again, it's not a Goldilocks scenario, but we are still on the optimistic side that we are going to avoid a recession in the US. It's a deceleration toward close to 1%. On the contrary, Europe should be doing a little bit better, in fact, due to this lower inflation. So it's regaining purchasing power. And more than that, central banks not only stop hiking, but they're going to start cutting rates in a quite a significant way going forward. And China is decelerating for sure, but it's doing what it takes, in fact, to get out of this situation. So probably north of 4% GDP growth in China. So the picture, macroeconomically speaking, is not that bad. The world economy is decelerating because it's more regionalization of trade, etc., etc. But clearly, it's not a scary scenario on the macroeconomic side. When we look at the market, then I think Joel is a very important call of Joel again to say that gas prices are going to be close to 40%. Oil prices are going to behave close to where they are today. So all this story is not putting at risk our inflation story. And then validate, in a way, our calls for the bond market year for 2024. This is the year of the bond market. It's not done yet in the pricing, in the performances. So probably looking at that in the bond market, maybe a bit of a re-steepening. Credit will be the name of the game, probably, and that's on the survey as well. So I think that's a decent play to make on 2024. And like Florent was saying, equity market is not dead for either, because we see some value here and there. So keep reading us. We are going to publish this paper. We have the website, we have the Twitter, we have the Meta, sorry. We have all this way to connect ourselves, but the best way is to give us a call, and we will be more than happy to discuss, visit, and exchange views. Thank you very much for joining us. Have a good day.